Welcome to the Entrepreneur Strategies Podcast, where we teach you how to scale your wealth, health, and family well-being. And in today's episode, we're going to be talking again about financial strategies for business owners. This is one of those kind of filler episodes where we're in between podcast guests. And so I'm just going to teach you what I do on a regular basis with all of my clients as a certified financial planner, helping my clients to really scale their wealth, reduce down their tax in regards to their personal health or in regards to their family. And so in today's episode, we're really going to be talking about some of the real big needle movers in helping businesses figure out how they can grow their balance sheet, how they can grow their assets while reducing down taxation. And so what are some of those financial strategies that a lot of business owners are either missing or maybe they know a little bit of and not maximizing to their full potential? And so I'm going to run through a list of those. There's about 6 different items that I'm going to be talking about today. Of course, there's a lot more than that when it comes to financial strategies for business owners. And really, the realm is endless. And so in talking about various different financial strategies, what are the ones that can really help you the most? And the first we're going to start off with is the entity structure of your business. And so that's really a big piece to and it's not a one size fits all, right? So it's going to be different for every business. What are you trying to accomplish? What are you trying to do? How many employees do you have? What type of business is it? All of that is going to really weigh into the entity structure that you choose for your business. But at the end of the day, it is one of the biggest differentiators. If you have the right business entity structure, then you can really maximize on some of those financial strategies. And so the first one is entity structure. So there's some great things about every different type of entity structure. Although I would say as a sole proprietor, that's probably the worst one because everything is streaming through as income to you, which means everything is streaming through and being taxed. So sole proprietors really doesn't make a sense for a lot of businesses unless you're a startup business, no employees, and you haven't really gained any or you made any sort of money at the current moment. Then sole proprietor kind of makes sense because you avoid then paying additional tax return fees for a different entity structure. So one of those entity structures is called a C corporation. And a C corporation does have some good benefits to it. Generally, C corporations are for much larger companies doing, revenue in the tens of millions of dollars. But it's not exactly desirable because you get taxed twice. You get taxed at the corporate tax rate, and then anything you stream out of the business then is going to be taxed at your personal tax rate. So it's really not ideal for most businesses. There is something really cool. It's called the Qualified Small Business Stock Tax Incentive. And what that means is if you have $50 million or less in assets and sales at any given time, and you have stock, because when you're a C corporation, you're going to have stock, shares of stock. And if you are likely going to own the majority of that, you could sell that stock and avoid almost all capital gains on it, and maybe all of it, but all capital gains tax on the sale of the stock. So basically, you could sell the company and sell your shares of the stock and avoid the capital gains tax. But there is a lot of requirements around it. And it does mean that you have to have been a C Corp for at least 5 years, which means for 5 years, you're being taxed at the corporate tax level and the personal tax level. So although it's a pretty cool feature, it doesn't make sense for a lot of people to go through 5 years of so much taxation just to avoid capital gains tax when you then go and sell the company. The next one is the S corporation, and the S corporation I do think makes a lot of sense for many, many business owners, particularly those that don't have a lot of employees and maybe those that are 10 million in revenue and below. And the strategy around that is, again, and I talked about this in great length, I think, in my last episode. If not, it was on my Instagram handle. And go check that out at _Mike Metzger. Really great tax tips and financial planning tips within that Instagram account. But as an S corporation, one of the strategies is being able to pay yourself a payroll, and you just have to pay yourself a reasonable compensation. And the benefit to doing that is, yes, you're going to pay payroll taxes, right? Because you're going to pay yourself. That money's going to come out of the business, stream through to you in the form of payroll. You pay payroll taxes, But then the owner's distribution, so like let's say you pay yourself a third of what you're making. Let's say you're making $300,000. You pay yourself $100,000 in payroll. The other $200,000 gets to avoid self-employment tax. So roughly skipping about 15%. So 15% tax. And so that $200,000 streams out to you, and you don't have to pay any sort of payroll taxes on that amount of money, or the self-employment tax, because when you're self-employed, you pay 15% self-employment tax, streams through to you, and then you pay your normal income tax rates. So this allows you to basically take about 2/3 of your income, roughly give or take, and avoid that 15% tax hit that you would normally take. There's some other benefits to both of these too. So with a C corporation, you can pay yourself benefits, or pay yourself in the form of benefits. So you can offer yourself dental plans and medical plans, and perhaps a gym membership, perhaps, like a lot of companies now, fertility treatments as a part of that employer benefits package. It's all sorts of things can go into the employer benefits package that most C corporations utilize to attract and retain employees. And so you can do the same if you're a C corp as well. So it's a great way if you have a lot of fringe benefits, other things that you're utilizing, and you want to get a tax deduction for them. The C corp is going to be a really great option for that. As far as the S corporation goes, there's less, right? So as a self-employed, you do get to write off your health insurance as an S corporation and being self-employed business owner. In addition, there are things that you can finagle around the health reimbursement account, so a health reimbursement plan. So maybe sometimes like something like daycare could be added into that, and that would be counted as a health reimbursement plan. So you're paying out of pocket, and then the business is going to pay you back for that. So that's called a health reimbursement plan, and those are eligible within the S corporation. So that covers benefits. Between the C corporation and the S corporation. Self-employed as a sole proprietor, really you're not going to get any of those benefits whatsoever, except for probably the health insurance would be a deductible expense. The third way that you can really benefit as a business owner and catapult your wealth and reduce down taxes all at the same time is through retirement plans. So retirement plans are really going to help, setting up the right retirement plan are really going to help you in your business and on the personal side. So help your business with tax deductions and help you personally grow your wealth and reduce down taxes. And so there's several different types of retirement plans. I've gone through this in great length before. You have a solo 401k if you have no employees or employees that work under 20 hours per month, or a spouse. If you have a spouse, you can also have a solo 401k. And that'll allow you to put away in 2024 up to $69,000. And the SEP IRA can do the exact same. You can put away about $69,000, but you are limited on the SEP side to 25% of your overall income into that plan. So you are limited to that. And if you're paying yourself in wages, it's based on the wages. So if you're an S corporation paying yourself through a payroll, 25% of the payroll that you pay yourself is what you're allowed to put into the SEP IRA. So the solo 401k doesn't have as many restrictions. But in either regard, up to $69,000 can go into those plans. And that's $69,000 going into a plan that you're investing in, let's say, the S&P 500, growing at about an average 9% clip. And then in addition, that $69,000 reduces down your income for the year and helping you save on taxes. So having the right retirement plan really makes a key difference. If you're just contributing to a traditional IRA at $7,000 each year, my gosh, please switch plans. There's so many better options for you out there. In addition to the retirement plan, if you have significant income, let's say you're doing $1 million in revenue and $69,000 just doesn't seem like a lot to put away, you really need to look into a cash balance plan or a defined benefit plan. Because with a defined benefit plan, it's based on your 3 years average income, and you can really start to sock away hundreds of thousands of dollars per year. And so now you can do it in combination with a solo 401k, and you're putting away the $69,000 in there. Plus, maybe if you're 50 and older, there's also a catch-up contribution, so you can actually get it above that 69,000 by quite a bit. And then, in addition, you have this defined benefit plan or cash balance plan. And with the cash balance plan, you're putting away another, let's say, $200,000 based on your 3 years average income. And so if you got $200,000 in there and $69,000 in there, you have now got $269,000 working for your future, earning significant amounts of money. That cash balance pension plan, when you're ready to retire, can just be rolled into an IRA, a rollover IRA. And then you can use it in retirement just like a traditional IRA. So there is a significant way to put away a lot of money into a retirement plan that'll help you in your future, but also reduce down your taxes in the current year. So think about that. Retirement plan plus a defined benefit plan of some type, like a cash balance plan. And you could really, really catapult your wealth and help yourself reduce down taxes, and be able to walk away from your business maybe a little bit sooner than you thought because you've built up quite a big nest egg for yourself. Another item to help you reduce down taxation for the year and really help you grow your business is large ticket expenses. And so think vehicles, machinery, computers, a podcast room, anything that has to do with your business that would cost significant amounts of money. You really want to strategize around when to purchase those, to purchase these larger expenses in those years, because that helps reduce down the amount that you're going to owe in taxes. It also, obviously, is a lot of that type of equipment helps increase the value of your business. And so it's increasing the value of your business and reducing down your income. But again, do it wisely in the years where it makes sense, when you really do need to reduce down your income. So if you can avoid it, let's say you're in a low income year and it's getting closer to the end of the year, and possibly you need a new car for the business, or a truck, or whatever it may be, whatever you're doing for your business. But if you're in a low income year and it's towards the end of the year, and if you can wait to purchase it January 1, that's going to help you tremendously. So don't purchase a large ticket item in low income years. Purchase those in the years where you really need to help reduce down your taxation, so higher income years. So that's a really great way that a lot of business owners, a lot of smart business owners are increasing the value in their companies and being smart around when to reduce down their income taxation. Another thing that goes sort of along with that is accelerated depreciation. So accelerated depreciation is an amazing tool to be able to use to help reduce taxes. And so what it essentially is, instead of depreciating an item over its typical lifespan, which is sometimes 5 years, 10 years, 27 and a half or 29 years, depending on the type of asset it is, you can depreciate it all in 1 year. Now, the caveat to this is the government, the IRS, has already started reducing that down. So they're phasing it out. So in 2023, you got 80% of accelerated depreciation, meaning whatever the item was, whatever the cost of it was, let's say it was $100,000, you can only depreciate $80,000 of that, so the 80% of that. And then it's going to go down ratably over the next few years. So down to 60, then 40, then 20, then 0. But there is significant proposals out there right now to bring back accelerated depreciation indefinitely. So it would come back, so it'll no longer phase out. You will get 100% of accelerated depreciation forever. And I do think there's a strong chance for this to pass, because it does encourage people to invest into the economy. So it does encourage people to buy commercial buildings. It does encourage people to buy residential properties. It encourages people to buy trucks, and all of that helps the economy. And so it is very likely, I think, in my personal opinion, that this will come back indefinitely. So accelerated depreciation is a great tool if you are renting or leasing a commercial space right now for your business. You may want to think about buying that property. And if you can buy that property, then you can accelerate that depreciation. So instead of taking small pieces of the depreciation over the 29 years for commercial property, you could accelerate a good chunk of that and take it all in 1 year. If you happen to have a really big tax year or a really big income year, that's a great way to wipe out that taxation. So accelerated depreciation is a really great tool. It's there for you to use. Again, keep an eye on legislation and what's going to happen there. But I do think, personally, I think that that's going to come back indefinitely. And the last thing I want to talk about is installment sales. So this is another tool that a lot of big businesses, a lot of smart businesses are using to help them, help them not only have consistent income over the course of time, but also to reduce down taxation. So an installment sale is like, if you, let's say you sell software, and you sell a major software deal to a 4,000 employee firm, and instead of taking that huge income, which sounds great, right? That is great. You now made a huge income, off of one contract sold, but that's also going to be a massive tax hit in that particular year. So what if you structured a deal with that firm and you said, you can pay me this, you owe me this money, but instead of paying me all this year for this 4,000 employee firm software deal, you're going to pay me over the course of 5 years. So you're going to pay me for the software, you're going to license it, or you're going to purchase it, and they're going to give you that in 5 installments over 5 years. And what that really does then is it helps make taxes a little bit more palatable, because it's going to be evenly distributed over the course of those 5 years. But in addition, you can even structure the deal to be beneficial for you in each individual year, meaning tailor that contract over the 5 years based on what your income is in each one of those years. So let's say year one income is pretty low. Okay, so give me 2/3 of that in the first year. The next year income is really, really high. Well, give me 1/4 of that, the remaining contract deal in the second year. And so you can play with it and make sure it's really being most beneficial to you in those income tax years. And that can really significantly help you. So installment sales is something that's highly underutilized, but it really can be used in almost any industry. And all you're doing is saying, don't give me the income all at once. I want you to pay me the amount of that contract or the amount of that product sale or whatever over the course of X years. And that can really help you reduce down taxes and it'd be beneficial for you in the years that you need it. So the years that you need more income, have the contract pay you more income. The years that you don't, and you don't want to have that tax hit, reduce that contract amount down for that particular year. And so those are 6 ways that can really benefit and bolster a business owner's profits, value of their company, but then also reducing down their taxes. So we had entity structure, choosing the right entity structure. Benefits based on that entity structure. There's certain benefits that you can provide yourself as a business owner, and it could be a tax deduction, as well as income or extra benefit to you. Retirement plan. So choosing the right retirement plan, and that's really based around what size is your company? Do you have employees? What's the income on the year? And what's really the main goal of it? So SEP IRA, SOLA 401k are fantastic. You put a lot of money into those. And then if you're really making significant income as a business owner, you really, really should look into a defined benefit plan, because you can stick away hundreds of thousands of dollars into that and grow for your future, and possibly then be able to exit and walk away from your business sooner rather than later. Large ticket expenses. So purchasing large ticket expenses based on your income years. In low income years, you maybe not want to do it. In higher income years, you should do that. And then along with that then is the accelerated depreciation, being able to accelerate the depreciation on that large ticket expense. And that'll really, really help you save a lot of money in taxes. And then finally, installment sales. So breaking apart contracts or income into several years versus all of 1 year. But again, I really hope that helped. That's six ways that a lot of business owners successfully grow their businesses while reducing down taxation. And I really think that can help you too. So if there's anything else that you are particularly looking for, feel free to message me. You can email me at mike@lifepointfd.com, or you can hit me up on Instagram. It's _Mike Metzger. I'm also on LinkedIn as well. I believe under LifePoint Financial Design or Mike Metzger. You can find me. You can find me there as well. Have a great rest of your week, everyone. And I hope those tips really help you as you're going into a new tax year to help reduce on that taxation and grow your business.